Hello, everybody. Brian here from quantlabs.net. This video is probably going to go out to any trader out there. I just thought I'd go over it, give you my 2 cents on it. As it stands right now, price action lab.com, going systematic is the only sound alternative. So if you're one of those buy and hold strategy holders, investors, you might want to pay attention to this. One systematic is the only sell alternative for investors to navigate the market noise and avoid the large drawdowns of buy and hold. Simple strategies have so far generated high risk adjusted returns. Now, I want to give you an example. I came across, well, it's not unusual to find people that can be fairly well off, work all their life, have a lot of money, and they don't want to pay the fees. I've been searching around myself. Going with a bank or anyone, you're usually going to pay by a bank or a specialized investment firm, probably between 1 to 1.5% of your portfolio. If it's a robo advisor, you'll find that you'll be usually paying between 0.5 to 0.7%. It's a robo advisor, but you're still not going to have any advantages over that. Here's why. If you go through an advisor, one thing that they should be good at is the downside protection. As it says here, a lot of people do the buy and hold. They will be overly exposed when the markets have a drawdown because they may not even know what a drawdown is. They think in their mind that markets will go up forever. We're entering into a very new time that I don't think we've had probably since at least the 90s. Meaning we are entering into a new, what they call new money system. A lot of countries, especially in the West, are heavily indebted. So what's happening is we're entering into a new money system and new paradigms are coming about on how all of that's handled. I think there's going to be a big correction coming. I think if you're overly exposed, not professionally managed, not with a decent advisor, you could get wiped out pretty fast because all that profit you've given back or earned over the years, decades even. I think if you're looking at 20 to 40%, some are saying up to 60% correction, that's given up a lot of your profits. And they seem to think, like here, that since the let's see what year this goes back, since the 1900s, oh, sorry, 19 is it 90s, they think that everything's going to continue to move up. I think with the debt situation, we are in trouble. It's not going to recover. At best, it might go flatline because of the debt. Interest, inflation, we can't avoid that as long as you stay in the West. So, as it says here, the only way to get around that is going systematic, meaning if you're trying to do a traditional buy and hold and assuming everything goes up, I think you're going to be in for a big disappointment. And especially, I have seen a lot of volatility in areas that shouldn't have volatility, namely treasury and gold. And those are supposed to be stable. There's a lot of volatility, unpredictable moves in these markets. So that tells you a lot of the markets are not safe. In fact, I got confirmation yesterday that there's something called rehypothecation that the banks and investment firms don't want you to know. Also, I've got confirmation a lot of the banks will tell you that going into gold is high risk, even though it's performed 20% year to date for 2024. So you got to ask yourself, what's going on there? There's things out there they don't want you to know. There's things out there they don't want you to question, and you have to know about them because something big's coming and it's going to be negative. So the only way to protect yourself is to be well versed in this world. Otherwise, you probably are going to run a risk of not not getting wiped out, but for what you've earned over the decades, you could lose and may not come back. And especially if you're on the verge of retiring, you got to be very aware of what's going on. So systematic trading is going to help you in a lot of ways, but it takes a lot of time and investment to understand that. And there's a lot of financial advisors and even the robo advisors I wouldn't trust. But to be well versed is very good. To be to know your investments and where they're going and why they're going in there. So here we go. Going systematic requires realizing the various furors, for furrows who operate in the markets and who pretend to have unique forecasting abilities are reality guessing the market next move. That is true. Going systematic is not hard. The simpler methods only require checking the price of the S&P 500 once at the end of the month and simple indicators data that are widely available online nowadays for free. We got Google, Yahoo Finance, you name it. But this period right here of requiring to check the S&P 500 once a month, that's like your portfolio advisors may only rebalance your portfolio once a year. The world will be in fire and they'll tell you that the world is okay. Obviously, it's not true. So you got to be a little more on top of it when it comes to your own savings. A lot of people say, well, I work, I don't have time, it's such a life priority. You know what? This is your money. These are your savings. To rely on other people to get through that as we enter into a new financial money system, I wouldn't want to be the ignorant one to ask, where did my money go when it happens? Research and know what's going on in the markets, the underlying. That's what we do, or I do, at the quantlabsnet.com. And it's one of the reasons why I use TradingView. It's one of the all-in-one platforms that's top game at what they do. And pretty, I won't say easy to use, it can't overwhelm you, but I've got things out there that can make life a lot simpler, namely the auto trading side. You just sign up here at quantlabsnet.com and just click on the learn and do it and do it now because it's all about simplest algo trading, automated trading, or as these guys say, systematic. Uh, since 1988, the 12-month moving average strategy, probably the easiest. That's basically the moving average cross. Buy when the monthly closing price crosses above the 12-month moving average and sell when it crosses below. Depending upon how this often is done, you could probably lose out a lot sooner, and uh, you could probably get caught in a steep decline too late because you're not watching it frequently enough. So basically, they're saying that this generated 9.98 annualized return, 21% maximum draw. That's pretty steep. In the S&P 500 index total return, Sharpe ratio is 0.79. So the Sharpe ratio, anything over 1 is considered not bad. Anything over 2 is considered really good. So this is your usual benchmark. But generally, the problem today is that the markets are so skewed with maybe 4 or 5, was formerly the Magnificent Seven, have now been whittled down to, I don't know, 3, 4 that keep the market afloat. There's a lot of stocks out there are getting killed along with ETFs. And that's been in place for a very long time now. Without those 3 stocks, we wouldn't be talking about this type of strategy at all because it would go flatline. Once those stocks start to underperform, then this type of strategy will be in deep doo doo. Simple strategy following based on price, series, momentum. However, execution requires a level of discipline. That's where the systematic comes in. So again, what they're doing is they're trying to believe you and lull you into this huge assumption that the markets will continuously go up using buy and hold and the S&P will continue. That is true along with when you have countries and Western countries with very low debt. Japan and the Bank of Japan and the Japanese yen's about to blow up. That's going to have a huge impact on the world economies. Same, look at what China is going through right now. as examples. The only one that's really holding everything up is the US. But since I would say it started in the great financial crisis in '08, but since the global sickness in 2020, that has really expedited the debt levels of spending, and it's still out of control. And that's going to change the world. It's going to change our future, the whole 9 yards. So we'll need to use systematic trading for not what it says here, but part of what they're saying is true here. Um, so how many? I don't know what they mean by furos. Maybe let's say gurus have outperformed the simple strategy. Personal estimate, none. Okay, that's a personal estimate. I'm sure there's a few, maybe 5, 10% that have done it, and there's a lot of other people that have beat it, but we just don't know about them. Uh, so what they're selling is complicated narratives that involve selection bias about the state of the economy using a few economic variables. This is no way to generate reasonable risk adjusted returns. Again, with that, that's using assumptions that everything will continue to go up no matter what. Um, I think, as I said, there's very few stocks out there, maybe three or four, maybe five, that are holding up the market and driving up the market because they're so skewed. But the good thing about a US market is that they're diverse and there's so many stocks out there that they can still get performance, but it's not going to be in your usual areas. Like if you look uh, at let's say Yahoo Finance, and yes, they'll say, "Oh, there's down markets." Yes, we're down. As you can see here in the top three, four indices. But if we look at the S&P right here, um, let's say if I blow up that chart in the full screen, okay, uh, try later. You can see here. Let me go. So we've had some dips here last year, here, but you can see it went pretty flat in 2022, which is quite rare. As an example, if you're sitting in US cash only, didn't trade, you would have made about 15%. So if you know about these things, you can still retain your portfolio and not lose money. But you got to know where to go and not be all in the markets like the S&P 500 because this will continue, but we will for sure have this period of a downturn longer and deeper. Okay, because as we move into that new money system, and that's just coming out of the global sickness right here, and look at that decline. If that was the truth of what this person's saying, that would be true. But last year was the very first time in about 50 years where there was a very strong downturn, and it will continue. And there is prediction that there will be extreme, what they call macro volatility in the markets that will impact S&P 500. So systematic trading is important, yes, but not just important what they're saying here, but it's going to be important um, moving forward. So again, you can see here um, right here. So we've had a lot of negative markets back in '05, but one thing to put out there is that the markets have always come back, yes, but I think it's different this time. Look at the real estate market, look at the debt levels, look at the number of people losing their homes, compare the price of gold that's starting to perform 20% year to date, much higher than than where we're at uh, in the assumption world. So if I look at Market Watch as an example to show you, just to compare, if I was to look at the S&P 500, okay, right now, here it is. So 1 year, 21%, year to date, 15%, 3 month, 10%. And then as we get in the shorter time frames, it drops and it drops a lot, right? So last year was a good year. that 21% is not maintained over the last few months because of the debt levels as we enter into the new financial system. And that's basically things like CBDC, central bank digital currencies, quite possibly UBI, universal basic income, and the like. So that's what I'm talking about when I say new money system, among other things that we might not even think about. Whereas with those kind of returns, we can look at maybe gold as an example. Um, Same with the bonds here. Let me go back to the main one here. So, as an example, bonds are not operating the way they should be. But let me show you gold. Gold right now, let's check out gold. So right here, you can see gold has done pretty good. So gold um, has done 22% and is as good as the S&P year to date, 15%, and so on, and 2.8%. So what's happening is in the 1970, when everything was removed off the gold standard, the Western world went into a debt service, a debt type of money system. We're on the tail end of that now. So we were taken off the good money system, the sound money system, where gold was that. And as a result, we're at the tail end of the debt money system and probably going to go back to more the sound money system, which is gold and the like. You've heard that many times. So this article here on is kind of dangerous talk, but systematic trading is going to be needed more than ever for your trading, and that's what I've got now to help you do that. So the next level of systematic trading, which is again, he's back on track, when we need it for portfolio allocation and timing. Timing's the key. You'll get better risk adjusted return and potentially create conditions to leverage alpha. Alpha meaning to beat the markets, S&P 500 as the benchmark. Funds that use strategies which are beyond the capabilities of the average investor. And again, that can be done in an automated way. Furthermore, highly debated that over the long term, these portfolio allocation methods outperform the simple ones. I would agree, kind of going back to the 1990s with that statement. But as we move forward, I think we're going to use systematic trading for the exact reason just mentioned to retain what we have so we don't lose wealth and to make sure we can still generate it, but in other areas you wouldn't think of. Like that's what I do with my analytics stuff. And it's still traded on the major US markets, like New York Stock Exchange, Dow, and the whole like. Um, so having some of these low beta with the market offer investors a high level of comfort. Yeah, for sure. But it's not about the markets themselves in terms of stock market versus ETF. It's the what we're investing into. As I said, like gold, maybe Bitcoin at certain points, but it is extremely volatile. There's other ones in the currency space like USD and the Japanese yen. That was doing really good. Same with the USD, Turkish lira, but they would be considered high risk. You don't have to bet the farm on those kind of currency combinations or crosses, but you would have made a lot of money over the last 4 or 5 years. You probably made a good couple 100%. Um, Backtest performance on of our ETF, R and RW. This is their simple strategy. Asset momentum, systematic, weak signals ensembles. So this is to their own strategy. That's how they get paid. Annualized return since 2008, 10% with less than 11% maximum drawdown. Here's the key you don't want, or you want to know about. You don't want to take on strategies that have a maximum drawdown of more than 15%. That's a standard. This is pretty good at 12%. Sharp ratio of 0.92. That's pretty good as well. Um, So higher frequency weekly allows for better fine tuning, but more work is required because they want to beat the 0.92. So that's where that is at. And again, if you want to know more about the easy way with systematic trading, go here, quantlabsnet.com, learn and get access to our 45-minute video on the highlights of TradingView and why I like to use it. Thanks for watching. Have a good day.